isn't fully catered for by the market at the moment. One of the ways you can do that is by helping develop the standards, and I know NSA are always happy for people to join their advisory groups. So going from standards now to perhaps taxes, Brian. Brian Thornton is partner in charge of the Galway office of KPMG, and Brian's presentation is going to be on renewable energy R&D tax credits, which I guess is a way of trying to claim some money back for your R&D project. So thank you, Brian.
Thank you, Joe. Just while we're waiting for technology. Yeah, as Joe says, I'm based in the Galway office of KPMG. We're one of the big four, so-called big four firms of accountants, tax advisors worldwide. I can never, for the life of me, remember the names of the other three. But we're also very large in Ireland. We have offices in Dublin, Belfast, Cork, and Galway. And I have a couple of colleagues here with me from the Galway office with audit experience and our VAT director. So feel free to ask us questions afterwards. I only have a short period of time. I want to scoot through the presentation. This isn't specifically designed towards the renewable energy sector. It's a fairly generic presentation, whether you're food, medical devices, pharma, software, renewable energy. These conditions and rules and opportunities would apply to you equally. To just outline, I suppose, what the shape of the presentation is, I'm going to talk about what is the R&D credit, why has it come in, how does it work, what are the key technical requirements, and what eligible spend can you take into account. It's interesting as to why it was introduced 10 years ago in the Finance Act 2004. Many of you will be familiar with the fact that Ireland has traditionally had a record of low corporate tax rates going back to the mid-50s. When export sales relief was introduced, if you were a company which was manufacturing and exporting, you paid zero tax on your profits. And then that persisted up until 1980, when the 10% rate of manufacturing tax was brought in, and again applied to companies which were manufacturing, no need to export. And then more recently, when the 10% rate of manufacturing tax expired in 2010, we have a 12.5% standard rate now that applies to the active trading profits of all companies. Whether you are manufacturing or exporting or neither. So if your active trading profits are taxed at 12.5%, that means the other profits which might arise with investment income, rental income, etc., are taxed at a 25% rate. But the standard rate of corporate tax is 12.5%, and that's not going to change. So that was an attractive, and is an attractive rate for encouraging Irish indigenous business, and also for attracting foreign direct investment. But in the context of R&D spend, particularly mobile R&D spend for multinationals, where they have, all things being equal, they might be indifferent as to whether they locate the R&D activity in Ireland or the UK or the US or whatever. Where in the US, depending on what state you're in, you can get up to 40% tax saving on your spend and your costs as a tax deduction. In the UK, 21% currently. France and Germany, higher, high 30s. So if you have subsidiaries as a multinational company in those jurisdictions, including Ireland, you might not be inclined to locate your R&D spend in Ireland if you're only going to save tax at 12.5%, or indeed 10% as it was when this came in 2004. So we have to do something as a country, A, to encourage indigenous spend in this area, but also to attract the mobile spend that these multinationals have and must have every year. We want it in Ireland. We wanted to make our products smarter, make our people smarter, and I suppose help them to put down greater roots and deeper roots in the Irish economy. So the idea was introduced to bring in this targeted additional incentive credit, whereby you can get your normal tax deduction 12.5%, but you can get a further 25% tax credit. So now you have a 37.5% tax deduction effectively for your qualifying R&D spend, and that's very attractive. And that makes us as good and probably better than most other competing jurisdictions for this mobile spend, and helping the indigenous business as well. Now, don't feel you have to take copious notes. I can make copies of the slides available, and we do have some brochures with us as well, which cover these topics, and I'm just skimming over the surface here. So that's kind of how the credit works. It identifies what the qualifying spend in the year is. You get your ordinary deduction at your corporate tax rate of 12.5%, but a further 25% write-off. That's very attractive, and it's a huge area of activity for us as advisors, advising indigenous and multinational companies. So What that means basically is you can write off this credit against your corporation tax liability in the year. It's quite flexible, and it has been improving every year in terms of its flexibility. We've had about 30 amendments to legislation since it was introduced 10 years ago. All of those, bar one, have been positive. All have improved on the credit by increasing the credit and increasing the flexibility in how you can use it. So much so that if you can't use the credit in the year of spend, you can carry it back against the prior year and get a refund. Or you can carry it forward indefinitely without any time basis for using it. So if you're not profitable or sufficiently profitable now to use the full credit next year, the year after, etc., no difficulty carrying it forward. Or indeed you can monetize it, you can turn it into cash immediately or at least over a 3-year period by seeking to get a refund of the amount of the credit in equal installments over 3 years. And we have a number of clients who are doing that. I have one client who we're currently working on to meet the deadline of later this week in filing, and they will be getting a €1 million refund from the revenue, equivalent to 1/3 of their credit entitlement. And this is cumulative, so in year 2 you'll have another instalment plus perhaps the first instalment of the new claim. So it's quite attractive. That's not to say the revenue don't police it. We do see the revenue auditing these claims, and quite rightly so. But if they are properly put together at the start, based on good contemporary documentation and a report which we would help you with, write up and compile, it should withstand revenue scrutiny.
So it incentivises companies, it does not apply to individuals, it incentivises companies to invest in Ireland and increase the R&D spend in the Irish economy. Creates jobs, become more innovative and help exports, etc., and drive the economic growth. So what are the technical requirements in order to qualify? There are 5. Now, forget about what Enterprise Ireland have, what the IDA have as their requirements, what your body in the Chamber of Commerce has said. These are the conditions. If you satisfy these conditions, you qualify. Is the work that you do systematic, investigative, or experimental? Is it a revenue-approved area of science or technology? It's very, very broad. It's quite enabling. We're really pushing an open door here in this area. Is it either basic research, applied research, or experimental development? I have to say, based on our experience of working in this area in the 10 years since the legislation came in, we have seen mainly category 3 there, which is experimental development. We see less of the blue sky thinking, less of the new applications of new technology that's typically done at head office level or Stanford, whatever. We see a lot of process improvement, a lot of developmental improvement, more the D than the R. And I suppose it's a bit of a misnomer calling it R&D. It can be R or D, in fact small d in practice. So process improvement, waste reduction, efficiencies, improving yield, all that can all qualify for the ordinary credit. It must involve the resolution of scientific or technological uncertainty, and it must seek to achieve scientific or technological advancement. That's not to say that you have to be successful every time, but merely seeking to achieve scientific or technological advancement. And it also doesn't mean that you have to be the first in the world with this idea. It does mean, however,
that the information that you're seeking may not be readily available. Your competitor may have it, or it may be written in Mongolian or something that you don't have access to, or you're not aware of it. But if there's a degree, any well-run business typically will simply not want to reinvent the wheel. But if you're actively involved in developmental improvements in your business where you're seeking to have these conditions satisfied, well then you are pretty much at the races with regard to qualifying for the credit. What areas of expenditure qualify? Very broad. If we start on the right hand side there, salary, fully loaded salaries for those involved full-time or part-time in the R&D activity. So by fully loaded I mean the gross pay, including employer's PRSI, pension contributions, VHI contributions, share option costs, etc., that the employer might have for the employee. All of those costs get rolled up into the gross costs, which can qualify. And then a proportion of those costs for people who work part-time in that area. Plant and machinery, very interestingly, can qualify as well if it's involved exclusively in R&D or part-time in R&D, and you take a proportional amount by reference to the period of its use. So let's say you estimate the life of the piece of gear to be 5 years, and you estimate at the start that you're going to have it in R&D for the first 2 years. Well then, 40% of that qualifying spend, net of grants, can be claimed immediately in that first year. You can true it up when you come to years 2 and 3, and if you find that, in fact, it's going to be used a bit longer in R&D, or it's going to be shorter than what we thought, you would then correct it in those years and amend your claim for those years. Subcontracted R&D can qualify to an extent. There are some limits, but they're becoming more generous. Indirect costs, establishment costs like light and heat, power, etc. Some proportion of the MD's costs, because that input is needed as well. And obviously consumables used in that space as well can all go into the pot in terms of computing the qualifying spend. And depending on the extent of the use of buildings for R&D, some of the capex on buildings, again net of grants, can also qualify. So it is potentially quite a material credit. We started advising a company in the west of Ireland just this year on their credits, and we're just about to sign off on a credit of 1.1 million hard cash credit for them, and that's at the rate of 25%, so you can work out the math and so on. But they're delighted with that, and a substantial increase on what they have been claiming heretofore, fully documented and a robust claim. Other eligible expenditure, I mentioned the potential for subcontracting R&D outsourcing to, for example, Martina in UIG or other third-level institutions, or to third-party companies. There are limits, but certainly it's encouraging to look at that and work in partnership with third parties and third-level institutions, because you may not have the expertise entirely in-house. If you've been involved in R&D for a good number of years, there is this base year concept which can come into play, which can restrict the amount of credit that you can claim. If you were spending money in R&D back in 2003, that's a permanent reference year, but it's only the increase on your spend above 2003 that qualifies. But if you're new to this area, new to this country, if you haven't been doing R&D in 2003, well then it's irrelevant. I do have some clients where they had significant spend in 2003, and that's a bit of a problem. But you know, we have to work through each case as they present themselves. Be aware that you only have 12 months to make your claim. So 12 months from the end of your year. So if, let's say, for example, most companies would have December as their year end, we're actively working on companies in terms of their claims, computing them and so on, for the year ending December 13. So 12 months after their claim is December 14. So we're working on making sure that they get their claim in on time. You may be aware that companies have to file their tax returns within 9 months of the end of the year, but you can correct that return because within the further 3 months period that you would have to file your claim. That's the one negative aspect, I suppose, of the change of the legislation over the last 10 years, is that all the other things have been positive apart from this area, where you used to be able to go back 4 years, you can only go back 1 year now. So it's quite strict in terms of time, and it's quite unforgiving. If you're outside the time, they will not entertain a claim, and it can be very costly. How does it work then? How do all these numbers feed into a calculation? Let's say, for example, the total fully loaded salaries the employer has to cover for people involved in R&D, full-time and part-time, comes to $500,000. Let's say the spend on plant and machinery, net of grants, and over its estimated useful life, the proportion I mentioned earlier in terms of its use in R&D, let's say it's another $500,000. And let's say the overheads, light and heat, some of the MD's costs, some of the financial controllers' costs, etc., all come to $200,000, including consumables. So you've got an eligible spend there potentially of 1.2 million. Let's say there's a grant in there towards the plant equipment and some of the labour hiring of 200,000. So you now have a 1 million incremental spend. And let's say you didn't have any spend in your base year of 2003. So you're not looking at the incremental spend above 2003. Everything qualifies. Your full 1 million spend qualifies at the rate of 25% credit. You have a $250,000 credit to deduct against your tax bill. So where your tax bill is 250,000, it's now zero. And if your tax bill is less than that, you can carry back the excess credit against the prior year, or carry it forward indefinitely, or elect to get a refund over 3 years of the full amount of the credit. So it's quite an incentive. It's there to be got. Certainly delighted to talk to you. If you want to have a chat afterwards, we're happy to do an overview, free to give an indication, etc. Invariably because we find people are leaving money behind. There was one big case some years ago where we were asked to have a look, and you could go back 4 years at the time. We found 6 million hard cash credits that have been underclaimed, and we were still in time to do so. So it's well worth taking a hard look at that area. So I suppose take-home points. Take-home points. I'm almost finished. It's very worthwhile credit. €25 rebate for every qualifying €100 spend that you have on top of your 12.5% write-off in the ordinary course of your tax calculations. Must claim within 1 year. There are document requirements. You must keep documents on a contemporary basis to show that you're doing this systematically, that it's not an ad hoc approach, and the review can be quite strict on that. And seek advice early so that you're tracking the costs as you go along, because corporate memory is short. People change jobs, change roles, and they're under pressure, etc. It's important to try and do it in real time if you can, as you map it on a go-forward basis, but it's very worthwhile. We'll be around later on if you have any questions, or you'll have contact details on the documentation on the website. Thank you very much.